So, what this session is about, as it says on the board, is define and differentiate between the four main forms of business ownership. We've already classified what it is to be public, private and voluntary. We already know what primary, secondary and tertiary is. So now we need to know and identify the advantages and disadvantages of the different forms of business ownership. Now, the information, a lot of it will be on the board, but I would recommend taking notes as well through this, because there are going to be bits that I say that, you know, you need to take heed of. I know it's been recorded, but still. There are four main types of business ownership: sole trader, partnership, PLC, LTD. There are others, such as a franchise, such as cooperative, which we will talk about in the future, but for the purposes of this lesson, we're going to focus on the main four. What we're also going to look at is how size and scale affects the choice of ownership. So if you've just got a start-up business, you aren't going to be a PLC. If you've got a business with 1,000 employees, you're not going to be a sole trader. And you'll see why as we start to go through this. Okay. The very most basic form of business ownership is a sole trader. And that's anyone. I would have thought all of you are probably classified as sole traders. Who's sold something on eBay before? Yeah, well, you're sole traders. Who's had a store at a car boot before? Again, you're sole traders. There's no complications to it. There's no documents, there's no paperwork, there's no registering with company's house. You just literally buy and sell and make some money. That is it. That makes you a sole trader. So like I say, the majority of you here are a sole trader already. So as it says there, it's really, really easy to set up. It doesn't mean, being a sole trader, that there can't be more than one of you. You can have employees. So you can see the picture there, it's a laminate floor installer. You could run your own business installing laminate flooring. You could book the sales, but you might know nothing about laying it. So you hire someone with the technical knowledge to do it. You pay them a wage, but in terms of the money made from the installation, that goes to you. There's more than one person in the business, but you are the owner, so you're still a sole trader. There are advantages and disadvantages of this. Some of them you can see on the board. You make all the decisions. So there's no arguing, there's no problems, there's no conflict, because you do what you want to do. If you've got an idea, you do it. If you think your advert should say this, that's what it's going to say. If you think it should be this price, well, it's that price, because it's only you. However, if something goes wrong, well, it's down to you. There's no one to fall back on. There's no one necessarily to get advice from. Those of you that have friends and family who are builders, plasterers, electricians, plumbers, anyone here? Got friends and family do that?
Yeah.
Yeah? Do they get sick pay? No? It depends on the business, but most don't get sick pay. Do they get holiday pay? Mostly not. Whereas, well, we get sick pay. We get holiday pay. Because I don't work for myself. I work for another business. It's a big difference.
And say you work for a building company, and the building company ain't got anyone to build for, and you can't go to work, so you can only work when there's the jobs available.
You can only work when there's jobs available, yeah. Because it's not based on a contract, is it? It's not based on a kind of, you'll work 35 hours a week and it'll be, it's just where when there's work, here's the work. It's a lot more risky.
No insurance.
Pardon?
There's no insurance as well if you get by.
What if something goes wrong? But it's down to you. That's the whole point, isn't it? If anything does go wrong, there's nothing really. There's no one to fall back on. There's no. Sorry.
Yeah.
Unlimited liability. That is one point that we will talk about in a moment. We'll come back to that in a sec, because that's the underpinning really behind all of this. Diversify. What does that word mean? Do diversification from the answer of matrix? It means do different things. If I'm a sole trader, I have to know a little bit about finance. I have to know a little bit about marketing, a little bit about sales, a little bit about production, sourcing, logistics. I can't just go, well, I focus on marketing, that's all I'm going to focus on. You can't do that. You can't specialise. You need to be the jack of all trades. And that's one of the big disadvantages. You do need to keep your accounts, because you need to give your tax returns. If you're making how many thousands per year, you're going to have to pay tax on that. You're going to have to pay, you know, because otherwise the government will come after you, aren't they? You've seen the adverts with the little white circle that zones in on people, taxes have to be taxing and all that. You have to make sure you provide your own tax returns. provide all start-up costs. So if you go to the bank, it's only you going to the bank. It's you asking friends and family. There's no one else to help you. There's no shares being sold. There's no revenue being generated. But one of the big things is you keep all the profits. You're not sharing it. It's not going off to shareholders. You're not paying dividends. It is all your money. So you can see there's benefits and there's drawbacks. Limited buying power. Because you haven't got that much money, you don't have the ability to buy in bulk. That's what economies of scale is. Those of you that haven't heard of it before. Economies of scale is the benefits you get of being a bigger company. So bulk buying. So the best example is multi-packs in supermarkets. You buy a can of Coke on its own, 80p. You buy 6 cans, it's not going to be £4.80. It's going to be a lot less because you're buying in bulk. The same with when you buy 1,000 tonnes of something compared to 1 tonne of something. You get a much cheaper rate. Now, unlimited liability. Go on and explain it to me.
Unlimited liability is, how do you explain? If the business go in debt, they can take your house, anything that you own.
Yeah.
If like it's 20 grand and you've got a car that's worth 20 grand, they'll take the car.
Yeah.
You can take anything that you own basically to pay the debt off.
Exactly. The reason behind that is you and the business are the same. You're the same legal entity. That's the key bit to it. You may have separate accounts, but you're classed as the same legal entity. So what Bianca was saying is correct. If you go into £50,000 worth of debt, you're going to have to sell off. If you sell off your business and that only raises 30,000, you still owe £20,000. You may have to sell your car, your house, your boat, if you're that lucky, to pay that off. That is the huge, huge disadvantage of being a sole trader. Unlimited liability, as in your liability, your ability to pay back debt is endless until you've paid that off.
It's worse in America, isn't it? They put you in prison and stuff, but more easily if you don't pay it.
I'm not too sure what the difference is internationally. If you can't pay a debt, you wouldn't normally be put in prison, but you'd have to be declared bankrupt. So it wouldn't just be your company bankrupt, it would be you as a person bankrupt. So you couldn't get a mortgage, you couldn't buy a car, you probably couldn't get a mobile phone contract. So it's got huge implications. Partnerships it's basically 2 sole traders working together. So it's moving up the scale. If your business is getting a little bit bigger, getting a little bit better, making more money, then you think, okay, I'm going to take someone else on board. Someone else to share the risk with. So you get more source of finance. Both of you can go to the bank. Both of you can ask your friends and family. But, okay, you have to share the profit. You have to share the costs. It's 2 to no more than 20. You can't have more than 20 people in a legal partnership. If you have more than that, you need to become a company. You need to become an LTD. So what this does, it gives you a much, much greater source of finance because you've got up to 20 people's asking, borrowing power, not just one. And obviously, if you've got 20 people, you can have your marketing specialist, your production specialist, your research analyst, your business analyst. You can have your person that is a specialist in each area, so you work together to be a much more well-oiled machine. So you can see straight away, hopefully, you can become a more successful business. Because there's no way one person can be excellent in everything. Everyone's got something they're best at. And if they dedicate their time to that thing, then they're going to be able to bring that to the table. The partnership deed is really, really important. What that is, it's basically an agreement contract. So it's saying who is responsible for what. So if there's 2 people, and you both invest the same amount, both invest 20,000 each, well, you would assume that you both share 50% of the profit, and you'd be liable for any loss, 50% of any loss. When it's 2 people and they both invest the same, it's quite easy to work that one out, isn't it? If you've got 20 people, all investing different amounts, you've got one person who started it off investing 100,000, then another 3 come in investing 15,000, and someone else says, oh, that's brilliant, I'll invest 50,000. How much of the pie do they get? And how much are they liable for if it all goes under? Bearing in mind that it doesn't have to be an equal amount. If, for example, you look at venture capitalists and Dragon's Den and the like, they don't actually have to do anything. It could be, say the business is worth, say it's £100,000 and they invest 50,000, that doesn't mean they have to get a third of the business. Because they might not actually contribute anything. They could just say, well, we're quite happy, this is a good business, give you 50,000 and we'll just take 10%. It's not 10% of the value of the business, it's 33 and a third of the value of the business. But because they're not being involved in the activities, they are asking for less. It's all what's agreed and it's all detailed out in this partnership deed. Because otherwise you don't know where you are.
If someone invests in you, they say they wanted 10%, would you keep having to give them 10%? Say, look, they start making loads more money, would you have to give them would you still have to keep giving money, or is it just one payment?
No, it depends on what. If you think of the Dragon's Den example, okay, when they say they ask for £50,000 for a 20% share in the business, that means that every year they're going to have to give them 20% of their profit. Every single year.
If you're making loads, it probably won't.
20% is huge when you think about it in the grand scheme of things. 20% of profit's a lot.
Oh yeah.
But then they need that money. They need that £50,000. But also the difference in that is they're not just getting the money, are they? They're getting the expert advice. They're getting, for example, the best example is Levi Roots, isn't it? Reggae Sauce. He didn't just get the money, did he? He got the ability to sell in supermarkets. You can get reggae Subways, can't you? You can get reggae pizzas. You can get reggae nachos and Wetherspoons.
But he's got loads of money.
It's very
What's
much
that
so.
other program?
It's
No,
got
Be Your Own
cookery
Boss. Is that
program
from
from
the
TV shows.
Innocent Smoothies? Like, went round
Levi
looking at
Roots.
people's
Yeah.
sales pictures and that.
That's it. It's different, isn't it? You get your money, you get a share, but you get a lot of added bonus, you get a lot of added value as well. But still, going back to partnerships, you've still got unlimited liability. So all these partners, you've got 20 people, you've invested all this money. If that business goes under, they are still liable. All their assets are still liable to be taken to pay off the debts of the business. So it's really, it's quite risky, maybe.
Who is to blame there?
You see yourselves. If the business goes under, it's your fault, isn't it? Really. It's like, for example, if you spent £10,000 on some materials that you thought were excellent, you took them down to you borrowed £10,000 from a bank, took it down to a market to sell, and you didn't sell them. It's your fault. You shouldn't have borrowed £10,000 because you can't sell them. So you're liable for that £10,000. If you were a company, you'd have had to justify that borrowing a lot more. They were talking about it in Sheffield. They have to really say, this is why I'm going to get this money, and so that's why the banks won't lend to businesses. Because why would they lend to a business if they're not necessarily going to get it back? I'll come back to this one. Okay, companies. Two different forms of companies: LTD and PLC. This is going to confuse you because they're so similar. Because when they're actually both PLC, aren't they? Private limited company, public limited. They could have made it clearer. Is my kind of point. They could have made it much clearer, couldn't they, on these abbreviations? However, private limited company, LTD. You're going to have to really quickly get used to these abbreviations if you're not already. Public limited company, PLC. Okay? So private, LTD, public, PLC. Now the big thing about these is they are a completely separate legal entity because you have shareholders. You buy a share in ownership of the business. So as you can see at the bottom, these have limited liability. So if you create a company, you have to register with Companies House, and you create your own, Apple, Poundland, whatever. You create your company. That means that you're a separate legal identity to the individuals investing in it. Okay. One of the main differences between these is LTDs, shares have to be offered. So if I'm deciding to register a company, and I think, I don't know, I like the look of some investors, or some investors like the look of me, they will ask to buy shares, or I will ask them to buy shares. They can't just buy them. They have to be invited to buy them at a given price. However, PLC, stock market. Okay, to be a public limited company, you have to have a certain amount of share capital, and you've got to be able to float your shares on the stock market, which means that anyone can buy them. Absolutely anyone. So to own the company, you must make sure that you have 51% of the shares, because otherwise you can't possibly make the decisions you want to make. So you can see here, you're starting to lose control of your business a little bit. You're not making decisions on your own. You're not making decisions as part of a small group. It's starting to become a little bit more diluted. You've got other people investing in your business. They're giving you money, so surely they're going to want to say. You've got random people investing in your business. Well, they're definitely going to want to say if they're investing thousands or millions in your business. So your vision is now maybe not exactly what actually happens with the business. That's what it says there. separation of control from ownership. Because you don't have that, not necessarily anyway, you don't necessarily have as much control as you did when you were a partnership or a sole trader. However, if you want to grow, you need more money. As a partnership, you've got unlimited liability, so the banks aren't going to lend you any money. Venture capitalists aren't going to lend you any money because you've got unlimited liability. They're worried. They're not thinking of you as committed enough. So you need to become an LTD, sell shares. You sell shares, you've got a much larger source of finance. You can expand. You can expand locally, you can expand internationally. You can increase your product range. You can research new methods of production. You can advertise more. There's huge amounts of things you can do if you've got more money. And as you move forward to a PLC, you can get huge amounts of money because you're floating your shares on the stock market. So you can see that as size changes, so does the form of ownership. Your smaller businesses start as your sole traders, go up to partnerships, to LTDs, to PLCs. It filters through. But you can see that the risks change, but the rewards change. The control changes because of the people involved. Okay? So what I'd like you to do, you've all got some notes there, I think. Can you just turn them upside down for me? Just put your notes to the side for 1 second. If you can, I need 4 groups. So Moses, to go to the back. Got so 1 group there, 1 group here, Jay that way, George that way. That's 4 groups. Sole trader, partnership, LTD, PLC. Tell me all you know about that form of ownership. But please do just turn your notes the other side over. Turn your notes the other side over just for a second. So I don't want you just to write it out again. See what you know from memory.